And third quarter earnings season is right around the corner. Our next guest says the key is to keep your expectations low. Thomas Hayes, Great Hill Capital Chairman and Managing Member, joins us now. So Thomas, let's start with September. We know it is typically not a good one for the bulls, and this year it's proven no different. We're down about, the SPX is down about 4%, more than 4%. Do you expect that, Thomas, to carry into October?
Well, Josh, thanks for having me. I think right now we kind of have had a washout. And to your point, the secret to happiness in life is low expectations. And that's exactly what we have in this information vacuum going into earnings season. As a matter of fact, earnings estimates for this quarter are negative 20 basis points, 0.2%. And what we've seen for the last few quarters is that estimates have been too pessimistic by 3 full percentage points. So if you knew coming into earnings season that earnings could be up 3 or 3.2% by the end of the earnings season, would you want to be short? And we've just come off of, speaking to seasonality, the worst 10 days of the year is September 16th to September 26th. So we're starting to pull through, and I think we're going to see bluer skies ahead.
What about the sort of backdrop, though? You know, we've been talking, Tom, a lot about the shutdown, the strike, you know, the sort of now delayed impact of interest rate increases on things like housing. Do you think that once earnings season starts, people pay less attention to all that stuff and really focus on earnings?
Yeah, I think that's going to be the shift. All the negative news is taking up the headlines. If we look at the shutdown, for instance, the longest shutdown we've ever had was 2018 to 2019, which was 35 days. And the S&P 500 was actually up 9.4%. When we had the shutdown in 2011, it actually created a bid in bonds, meaning bonds went up and yields came down. So maybe we do need a shutdown for a few days just to get that 10-year yield back below.
Oh, no, don't say it. Don't say that.
But I will say one thing. We did look back at yields since 1960, and really the market's gone a little sideways once the 10-year yield went above 4.5%. And what we saw was that there have been like 11 instances since 1960 when you had a quote-unquote breakout in yields where people thought it was just going to keep going higher, and those breakouts turned out to be fake outs. And no one's kind of considering that right now, but I think as you get closer to year end, you're going to see a tremendous amount of pension demand with long-dated liabilities step into the market and actually create tremendous demand for the 10-year yield, for the long end of the curve, which could put a cap and bring those yields down, which would help a lot of the sectors that have been beaten up by higher rates, namely housing, namely REITs, namely utilities, any interest rate sensitive sectors, and even banks to a lesser extent, because while everyone's focused on the re-steepening of the curve, what they should be focused on is the mark-to-markets, which is what hit the smaller regional banks, and there may be some opportunity there into year end.
Yeah, Thomas, so let's talk about opportunity. Given that backdrop, where do you see opportunity right now? Names, sectors, what do you like?
Yeah, well, I think first and foremost, as it relates to the 10-year, hedge funds are the most short they've been since the 2018 lows. They're the most short that they've been. So we think we are going to see a recovery there. We like actually 2 industrial stocks, which have been beat down since their 2021 and 2022 peaks. Both are down. One's down 67%, one's down 80%. The first one is Stanley Black & Decker. And this sounds like a boring business. It kind of is, and that's a good thing as far as we're concerned. 85% of their business is tools. Think DeWalt, think Stanley, think Craftsman. And 15% is industrial, which is going to benefit from the Inflation Reduction Act as hundreds of billions of dollars come into the market over the next few years. When you think construction, you think tools, and they kind of control the market. What has happened, like many of these companies, is they over-ordered because they couldn't get parts, so they just put in a lot of orders. They built up those inventories, and they overhired. And they're working through both of those issues. They've taken down inventories by $200 million. They're going to take them down by $750 million to $1 billion by the end of the year. And they've taken out a tremendous amount of cost. They've already taken out $430 million in cost. They're expected to take out over $2 billion in cost by 2025. Now, why does that matter, Josh? That's $13 a share in cost. And when the stock was trading at $209, they were earning $10.85. So if you think about normalized earnings plus the cost reductions, you could have a stock earning $15. And whether you put a peak or trough multiple on, that could be a double over the next 12 to 36 months. So we think there's tremendous opportunity in Stanley Black & Decker as they recover.
The other one you like, Generac, has been one, man, that one has been beat up quite a bit. Recently had a recovery, I believe it was yesterday, after the company basically said things are not going to get worse. They didn't cut their forecast, they just reaffirmed their forecast. But it too has seen these really uneven sales trends. So normalization, those people who have bet on normalization, whatever industry you've been talking about, it's been tougher than many had expected. Do you think that Generac's finally going to normalize here?
Yeah, I think it's overshot. I mean, the stock is down 80% off its 2022 peak. So I think that it's priced in kind of a worst case scenario. This is the Kleenex of home standby generators. When you're going to buy a generator, you say, I'm going to buy a Generac. And with the electrification, what we're seeing is greater fragility in the electric grid, more outages, more unusual weather circumstances. And what's interesting about their business is the more penetrated a state becomes, the more people that have them, the higher the growth rate. Most people would say, well, it gets saturated. Well, in the states that actually exceed 10% penetration, their growth rates go through the roof, because basically what happens is you get a storm or you get a power outage and you realize you're the only one on your block with candles, and you say, that's never going to happen to me again. So the more people that have it, the more people that want it. Right now, throughout the United States, in homes over 150,000, they only have 6% penetration. And every 1% increase in penetration is a $3 billion market opportunity. And that doesn't even include the power walls, which is 10% of their business, their battery storage, their clean energy, their solar. They're getting into EV charging, and their commercial and industrial business is growing like a weed. With the telco 5G build out, they need redundancy and they need power backup. So, this stock historically trades at about a 29 times PE multiple. It's currently trading at a 14 times PE multiple. So we think there's a tremendous opportunity for upside. And we think also this stock could be a double over the next 12 to 36 months. So we like these opportunities.
We shall see. Thomas Hayes, Great Hill Capital Chairman and Managing Member. Thanks so much.
Thank you.